whether it is enforcement or it is civil litigations that you have. But if you have like no voice, then of course there is no borrower's voice.
So it's the bank's fault that NPLs are at 12%?
Part of it is yes.
They did do the loans.
Yeah, well, that's true. That's true. So they
Part
can
of it
do
is
something
yes.
about it in India.
They are doing, and the regulator is helping. And there have been massive changes over time, last 7-8 years. I think one directional change has always been creditor friendly. Political wind is more, I would say, lender friendly today, which because it's state-owned bank, again, there is intervention of politics. And it's a democracy, so everyone will have everyone, somewhere or the other, which essentially means the lending process may not be what you want it to be. So starting point is wrong, so of course the end point is wrong, right? Can the intervention change that? It is changing. And directionally, if you look at over the last 5, 7, 8 years, the regulations, process in court, outcomes are all creditor friendly. And fortunately, they are more foreign friendly, which is interesting in certain countries at least. So, but again, I would still think that with all this, you can't ignore the bank. Do you want to work with them? Yes, but you need to control your destiny. Which means you have your own sets of issues where you can enforce without them, because they may move very differently than what you would like to.
Okay. I just want to, at this point in the panel, let you know that in around about 15 minutes or so, we will open up for questions. So just to give you guys a chance out there to think about, you know, I'm sure it's not every day that you have people like this sitting in front of you. So we'll open up in around about 15 minutes. I didn't check that was okay, so I hope that's okay for whoever who's in charge out there. Anyway, the other thing that I wanted to do was change the direction of this conversation slightly. I want to talk about negative interest rates. Do negative interest rates work? Let's take Japan. Let's take Europe. I think the panel's leaving me.
So I'll take the bait. And Oriel's referring to a pre-conversation we're having. I can say this, since the title of this is, again, well, it was Credit Market Outlook. I think we've and I'm going to maybe sort of quote one of the few people in the world who's more intelligent than Larry Summers, which is Mike Milken, which is speaks to this, which is you're making a decision. If you're doing nothing, which gets you zero, or if you lend money for a long time that gets you zero, you're doing nothing, and you might be taking more risk. I cannot understand fundamentally why anybody, and there are allocators out here who did this, would Glencore borrowed at negative rates a couple weeks ago. Glencore is a company that was being written about, rightly so, in February, as a company that may be insolvent. And to go from insolvent to borrowing at negative rates, I mean, this is where I completely agree with my friends in the Asia panel. I don't understand why anybody would lend money to Glencore or most companies at negative rates, when in fact, there are so many opportunities, whether it's US middle markets or upper middle markets in Europe or many different things in Asia that have real growth that are yielding sort of 4, 5, 7, 11. I mean, we're putting on loans at 11 or 12%, where the ultimate where the ultimate risk is actually AAA rated companies. So no, I don't think they work. And part of the grisly point of inflection that I was talking about is when either the markets wake up and realize it, or the central banks stop running the presses, which I don't think is happening anytime soon. So actually, no, I don't think. When we talk about the Japanification of the rest of the world, well, what's happened in Japan in the last 20 years hasn't been necessarily a model that we all want to aspire to. So A, I don't think it works, and B, I truly think that those people who buy Glencore or any of the other sort of triple B companies at negative rates, I think are actually failing on their fiduciary responsibility.
Is there anyone on this panel who thinks that they work? Negative interest rates?
I think they only create more volatility, which kind of makes it more, you have to be more nimble around it. because with this rates in Japan, still people made money in Japan in real estate or in credit, but incredibly short periods of time, and it cannot be a strategic decisions to put money.
So is that a yes?
No.
No.
Only opportunistic. You can trade in, but you can't put strategically allocations.
A dangerous precedent for the world, and that brings a more central bank question that does create real precedents. I think the point in sync with my colleagues on this panel really is that we all need to acknowledge rates are lower, right? But we think their risk-adjusted returns are still interesting. Frankly, a long credit, and if you stay locked up and look at private credit across the world, you have to be there, but you also have to, I would say, be frank with ourselves in terms of what is that rate of return that is, I think it's just frankly lower than it used to be.
So why are the big names out there, and when I'm talking about big names, I'm talking about people like BlackRock, why are they buying negative yielding debt?
I think the key, a big key, and Rob hit his head on it, there's a big difference between private credit and public credit. And I think the world, especially since the global financial crisis, overvalues liquidity. What people are willing to pay for what I would say perceived liquidity. Because by the way, that Glencore bond is liquid until it's not liquid. And then it becomes as illiquid as any of the stuff we're invested in. And I think that the good news for not only the folks in this panel, but most of the sponsors that we see on screen, it gets back to what the Arena Capital guy was saying is it's changing in the US pension system, but private credit doesn't fit into the nice box that most of the BlackRocks or the PIMCOs are sort of selling into. And let's hope that stays that way. Let's hope they put all their money into sort of Glencore at negative rates rather than our stuff. Because what the Arena Capital guy said, and I agree with, is when something doesn't fit into a box, there's opportunity. So what all of us do on this stage doesn't fit nicely into a box. The question then becomes, is there enough private credit out there globally or in Asia? These wonderful sort of NPLs that Rob and company are investing in. Again, maybe you can put 10 or 20 billion to work. The issue that BlackRock and PIMCO have is they have to put 100 or 200 billion to work. And the day that they start putting 100 or 200 billion into our market is the day that I'm going to be doing something else.
Do you agree?
I would agree with that. It is still very early days in terms of the number of caliber managers that can put out money, and maybe collectively we have $10 billion, maybe even $20 billion across Asia, and that is nothing. That's a drop in the bucket in the $37 trillion market opportunity set. So, boxes that are imperfect and indefined, we love them, right? And that creates great opportunity. I will say we are finding the pension funds, as I was saying, my first inflection point, really understand that and are working slowly, steadily, progressively to allocate increasingly from their fixed income bucket at the 2% world into the private credit, alternative credit, opportunistic credit, whatever they call it. Those buckets are growing. And they're not growing against PE, they're growing from their fixed income bucket.
As an Asia-specific manager, two Pan-Asia-specific managers here, how closely, and this is a genuine question, are you watching the Federal Reserve? How much does it really matter to Pan-Asian credit?
It matters more on the liquid, to be very frank. And I think I'm worried about the liquid high yield market today in Asia. High grade, fine, short duration, it's more about parking the money and preserving capital. But high yield, it's in the dangerous territory. Default rates are still going to increase. What is reflected in the NPL ratios of the banks may still go up. So then what we do is do private credit, and there, honestly, I don't worry at all. Whether the rate is 25 basis point up, down, doesn't matter.
It doesn't matter to you. How much does it matter in China, do you think?
I can't really comment too much about this, but I just want to follow up on what Shyam said about NPLs and also default risk. So what we've seen in terms of default risk is it's been very low. In fact, it's less than 2%. It's still, well below the average for the last 35 years. Even though, for example, in China, we have some really sharp deterioration in terms of credit risk in the last 5 years. And some companies are not really generating enough cash flow to service debt. what's keeping these companies from going, tipping over really is liquidity. Liquidity provided to high yield issuers to refinance in the market at very low cost. And also investor managers chasing yields for, bidding down, sending the yield down like from 10% to 5% or less than that for high yield. So high yield investment doesn't really exist anymore in Asia.
But the interesting question, and maybe you're probably one of the best positioned people to answer this. You're talking about liquidity of investors, and that's an interesting point. What Mike Milken sort of pointed out, I think very articulately at his sort of LA conference was something interesting, which is in the last sort of half century, there's been a credit downturn. Sub-investment grade defaults have gone above 10%. I think it was U.S. rather than global, every 7 or 8 years.
Yeah.
Well, we're 7 or 8 years. Should we be worried? And what he pointed out was there's sort of 2 reasons why, in the U.S. anyways, there isn't. We shouldn't be worried yet. And one was maybe less liquidity of investors, although I think it's a point. What he pointed out was that free cash flow, the ratio of free cash flow to interest coverage, is the lowest it's really been ever. And so it was not so much liquidity of investors than it was just liquidity of corporates. So that's a good kind of liquidity, because that tells me that maybe that 8-year cycle could go out 9, 10, 11 years in US corporates. I think the other thing he pointed out is that the downturn in energy was, as opposed to the previous 2 downturns, subprime and dot-com, which were very broad-based, downturn in energy was mixed. It was probably positive for Asia, definitely positive for Europe, and positive and negative depending on the industry in the US. So my question to you is, liquidity of investors as the reason why defaults are low, very scary. Liquidity of corporates, not so scary. Where is Asia or Greater China on that spectrum? Because if you answer that question, then you're going to find out, A, where your point of inflection is, and B, how grisly it's going to be.
Okay. I think it's really the former, the investors' liquidity that's supporting some of these high yield issuers. If you look at free cash flow as a measure, they have been persistently negative over the last couple of years for a lot of the issuers, including some of the investment grade issuers in oil and gas from China, some of the more aggressive M&A players out of China.
So Rob is going to have a lot more NPLs to invest in pretty soon.
Yeah, the question is whether the state banks will sell those NPLs to third-party players. But we're talking about very massive numbers that are coming out of the state system. So I am very cautious about liquidity, because if I just look at default rates in Greater China, we have been holding steady at 4 defaults a year, and that's less than 3%. You're absolutely right. If we look at history, every 7 to 8 years, we have a spike in defaults, and with high, spec rate default reaching 10% at every peak cycle. So we are not well below that at the moment. So I think we're just climbing. We're in a climbing stage in terms of a default cycle.
Rob, where are the opportunities in credit in the States?
Again, I keep quoting people, but what sort of the gentleman, Gordon Fife, what he said, and I agree with him, is bad is good. So there's sort of 2 or 3 reasons why, A, we like senior secured loans, and B, we like them through banks. One I already spoke about, which is when things go wrong, I get help. I get, 200 or 300 people in their workout department that I don't have to pay for, which is fantastic. I think that the opportunities, as well articulated by Mr. Golub, is in the middle markets in the U.S. But unless you are either Golub or 3 or 4, maybe 5 other people who are big enough to basically be banks. I mean, once you have 20 billion, you have enough. I mean, if you have 125 people looking after the revolvers, you might as well be a bank. So for those guys, they're the exception. I think the opportunity in the States and in Europe to have senior secured loans is to team up with the banks. A, because they give you their origination, servicing, underwriting, and working out for free.